Good morning, everybody, and welcome to the webinar. My name is Michael Lanahan. Upon DED's reorganization, I will serve as Director of the Business and Community Solutions Division, which houses the redevelopment team, and I'm honored to stand alongside some of my redevelopment colleagues today. Thank you all for joining the call. The purpose of our time together is following the statutory updates last year to the state historic tax credit, or historic preservation tax credit program. We have instituted new rules, working hand in hand with a lot of you all on the call. We really thank you for your input that we've gotten over the past several months, much of which has been incorporated into the rules. And during our call today, we're going to go ahead and talk through those statutory updates, the new regulations and what they do, the guidelines and application, and the cost certification. We will follow up shortly with written guidance regarding the status of existing applications, and we'll post written information on our website and reach out to applicants directly via letter to ensure clarity and consistency on that front to make sure that everyone's on the same page. So without further ado, I'm going to introduce my colleagues from the redevelopment team, Mark Pauley, Vaughn Koch-Anderson, Landon Garber, and Jennifer Kingsbury. I'm going to pass the baton for Mark, and they're going to take it from here. Thanks again for joining. And just one last note, we will have questions at the end. You can either, we'll unmute your microphone and you can ask there, or you can type them in, either way. So Mark, take it away, sir.
Thanks, Michael, and good morning, everyone. I'm Mark Pauley, and I'm the manager for the development finance team. We house a lot of the programs that are aimed at redevelopment, such as the Historic Preservation Program, Neighborhood Preservation, Brownfield Remediation, and State TIF. The topics we'll be covering on today's webinar are the Senate Bill 590 legislative changes, the new rules, the new guidelines and application, and changes to the cost certification. And again, as Michael mentioned, at the end we'll open it up to questions, and you can ask either one of two ways. Just click on the button, raise your hand, and you can type in your question, or we'll unmute you and you can ask it live. So we'll go ahead and get started, and I'll be going over the legislative changes that were made to the program as a result of Senate Bill 590. One of the more significant changes to the statute is that the cap has been adjusted from $140 million to $90 million, with an additional $30 million solely for projects located in a qualified census tract. This only applies to projects requesting $275,000 in credits and over. Credits will be first authorized from the $90 million bucket, which is allocated for all projects regardless if the project is located in a qualified census tract or not. Once the $90 million is allocated, we'll move on to the $30 million allocation. If both the $90 million and $30 million caps are exhausted in any fiscal year, DED will make a one-time adjustment to the maximum amount of credit by the percentage increase in the Consumer Price Index. The change to the statute also added several new requirements for approval, which is subject to all applications. Those requesting credits over $275,000 and those requesting credits under $275,000. The first one being a copy of all land use and building approvals reasonably necessary for the commencement of the project. And we realize that the requirements for land use and building approvals is different for each municipality. However, at a minimum, we would need building permits and zoning approvals, which are universal to all projects. Starting with applications receiving approval on or after July 1st, 2019, the applicant will be required to submit evidence of project financing within 60 days following the authorization of credits. The documentation we need is a line of credit, an actual executed loan agreement, or a letter of commitment. We would encourage you to go ahead and send in that information with your application submission if it is available. Additionally, for projects that are over $275,000 in credits, there are new evaluation criteria. Landon will be going over each of these later in a little more detail, but the areas of consideration are overall size and quality of the project, level of economic distress, net fiscal benefits, input from elected officials. The time frame for all approved applications to commence rehabilitation has been revised from the previous 2 years to now 9 months. So all projects that have received approval after August 28, 2018 will need to have started actual physical work within 9 months of the authorization letter and incurred no less than 10% of QREs. Another change is the change to the statute where the amount of the issuance fee has changed from 2.5% to 4%, and that's for projects that were received on or after August 28, 2018. Okay, Bankach is up next to review the new rules.
Good morning. My name is Bankach Anderson. I am the Program Administrator for the Historic Preservation Tax Credit Program. Today I would like to discuss about the new rules affecting the program. We filed the rules with the Secretary of State on March 20th, and they became effective on March 30th. Any incoming preliminary applications received by DED on or after March 30th are subject to these new rules. I will begin with the definitions. We revise certain definitions and add new definitions to the program. Let's start with revision to the existing definitions. Identity of interest, or IOI. Initially, there were 7 conditions for identity of interest, and if any of these conditions apply to the project, then identity of interest is applicable, which will affect how we review and determine qualified rehabilitation expenditures. IOI can exist when applicant has financial interest in another party, or when one or more of the officers, directors, stockholders, or partners of the applicant is also one of the above, or when any one of them has financial interest or controlling interest in the operation of the other party. When the other party advances funds to the applicant, pays on behalf of the applicant for costs related to construction contract, or consider interest or consider stock or interest in the applicant as part of the payment. Or when it's a site deal agreement or promise entered into that would change or cancel the original documents submitted to DED at initial review. The 2 new conditions that we include are when any party involved in the project who owns the stock of another party involved in the project, or when any party involved in the project has a stockholder, member, partner, officer, or director that is related by blood, marriage, or adoption to any one of the above of the other party. In my opinion, I believe that this last condition will affect how we review and determine identity of interest for small to mid-sized projects. Another term that we revise is non-qualified rehabilitation expenditures. They are part of the total project costs that are not qualified for tax credits. Non-QREs, or non-qualified rehabilitation expenditures, or non-QREs, they include but not limited to the list of non-qualified rehabilitation expenditures published on the program guidelines. Qualified rehabilitation expenditures, or QREs, they are used as the basis to calculate tax credits. They include but not limited to, first, the QREs defined under Section 47C2A of the Internal Revenue Code as amended. Second, a list of the QREs provided in the program guidelines. You can find the list for both QREs and non-QREs on our website. In this case, your application will be subject to the list on the day that we receive your complete preliminary application. Now let's move on to the new definitions. Inactive project. In this case, inactive project, it is a project either with pending or approved status in which applicant fails to communicate a response to DED for a period of 9 months from the date that DED sent out the last correspondence to applicant. Incomplete application. It is an application received by DED which does not conform to the rules, program guidelines, or instructions. Phased project. It is a project in which applications received by DED stating that a project will be reviewed and complete in more than one construction period. And in this case, construction period is a rehabilitation period with the start and end dates. Now let's move on to the preliminary application review for project of $275,000 or more in credits. As you know, a project this size is part of the cap. Like Mark mentioned earlier, the cap for $90 million is for projects located statewide, and the $30 million cap is for projects in qualified census tract. Approval will be given to the $90 million cap first before the $30 million cap. We have 2 application cycles per fiscal year. The first cycle will start on June 3rd and then October 1st. Fiscal year 21, it will be on or after April 1st and then October 1st. We will publish the application cycle on the website in advance before beginning the cycle. We prioritize the incoming applications based on the postmark date, with the oldest postmark date receiving priority. If we receive applications with the same postmark date, they will go through lottery process. Please understand that any incomplete applications will not be further reviewed by the ED. So please ensure to submit a complete application according to the checklist. We use scoring criteria as part of the review with the total of 100 points. Scored applications by the ED will be categorized into 3 tiers. The first tier is for applications receiving 70 points or above. Second tier is for applications ranging from 31 to 69 points. And the third tier is for applications receiving 30 points or below. Applications with the same score will go through lottery process to determine the order for SHPO review. Top scoring applications in this case will be forwarded to SHPO, and we may be able to issue the approvals upon receiving SHPO approvals of the scope of work review without conditions. When can the applicant claim the expenses as part of the eligibility? For hard costs, they can be considered for eligibility if they were incurred on the later of 1 month before receiving preliminary application by the ED, or 6 months before receiving preliminary approval from the ED. Soft costs can be considered for eligibility if they were incurred on the later of 6 months before receiving preliminary application by the ED, or 1 year before receiving preliminary approval from the ED. Please ensure that all of the documents pertaining to the project, ranging from sources of funds, loan documents, construction contracts, architectural contracts, invoices, receipts, and all proofs of payments, cancel checks, bank statements, that all of these documents are in the applicant's name and authorized by the applicant. The third-party payor paying on behalf of the applicant, either if they are related to the applicant or not, or either if they got a full reimbursement or not, in this case, will not be eligible for tax credits. Title company paying on behalf of the applicant will not be considered third-party payor. Phased project. To be eligible for phased project, the applicant must first file for the federal application as a phased project, mimic the state construction period to the federal phases, and then submit separate state preliminary application for each construction period together at the beginning of the project. Because we treat each construction period as a standalone project, the applicants must meet all of the program requirements, such as meeting 50% basis, receiving SHPO approvals for both preliminary and final applications. Any costs incurred in one construction period must be claimed within such construction period. Applicant is not allowed to carry costs incurred in one construction period to another period. Developer fee. If you plan to claim developer fee as part of the qualified rehabilitation expenditures, please ensure that you submit the agreement in the form prescribed by the ED, and the form can be found on the website, that the original agreement and any amendments, if applicable, that they are signed and notarized by both the owner and the developer, and that you submit the signed and notarized agreement to the ED at the beginning of the project before the later of initial closing on construction financing or initial closing on federal historic tax credits if applicable. The maximum fee is 12% calculated from total qualified with rehabilitation expenditures minus identity interest fee and minus developer fee. If you have to amend the agreement, the amendment must be reasonable. And if you plan to accrue the fee beyond receiving tax credits, the accrued fee must be paid within 5 years of final completion. In this case, final completion is defined within the agreement. When we receive your final application, it will be reviewed using the rules and the guidelines based on the year that you submit the preliminary application to DED. For example, if we receive your final application today, but you file the preliminary application back in 2013, your project will be reviewed using the 2013 guidelines and rules. If the actual amount of the tax credits eligible for the project is more than the amount that you have been approved at initial review, you may request additional tax credits after receiving the original certificate from DED. In this case, please understand that the request for additional tax credits is considered new application, which have to be reviewed according to the statute. DED may administratively close your inactive project upon notifying you in writing, so please ensure that you respond to us in a timely manner. Let's move on to the guidelines and application. We will focus on the preliminary application. If you are applying for both state and federal tax credit programs in the past with the previous guidelines, we ask applicants to submit state and federal application to DED, and we would forward them to SHPO review. We did that as a courtesy. With this new guidelines, we would kindly ask the applicants to submit federal applications directly to SHPO office. As for the state applications, they have to be submitted to DED for review. With this proposal, we hope that it will help expedite the review of your federal application by SHPO and NPS. New information that we would ask as part of the preliminary application for project size of less than $275,000 and project size of $275,000 or more. First, we'd like to know the square footage of the building before and after completing the project. If you are expecting to create new jobs, in this case we would exclude relocated jobs or construction jobs, we would like to have information for job classification. If you are going to lease part of or all of the property to tenants, we would like to know if you have tenants in place. Project of $275,000 or more, we'd like to know the current assessed value of your property at the time of application submission. We also would like you to provide a project narrative just to tell us how important your project is to the state and the local government and the benefits that it will bring to the state and the local municipality. New information that we would ask from the applicant as part of the review, again, project size of less than $275,000 and project size of $275,000 or more. If you are going to create new jobs, please fill out the job classification sheet. We would like a copy of land use and building approvals or permits. For project of $275,000 or more, please provide a document showing the current assessed value. The latest year's tax bill in this case would be sufficient. If you are applying for tax abatement program, we would like to have a copy of the tax abatement application and executed agreement between you and Land Clearance for Redevelopment Authority, if applicable at that time. Project size of $275,000 or more. This is pretty much related to scoring criteria. We would ask that you filled out the HTC self-score sheet. This sheet will have multiple sections and 2 exhibits. You will also find the HTC self-score guide on the program website. It will tell you the instructions and how to fill out each section and the documents that must be submitted as part of the review. Please attach a copy of the projected budget, proof of financial commitment for each source of funds. a map for the federal opportunity zone just to see if your project is located within such zone, map for qualified census tract to see if your project is in the tract, copy of census tract's overall poverty rate to compare the poverty rate in your area versus the statewide. Table showing the average vacancy rate within a one-year period before submitting application. This is applicable if your property has been vacant within the one-year period before submitting application to DED. If you receive local support, we would like a signed letter from elected officials in your local municipality. If you receive local incentives, please provide firm commitment of such incentives. I will introduce my colleague and my dear friend, Landon Garber. He will discuss more in detail for application scoring review.
Thank you, Bankaj. Good morning, everyone. I'm Landon Garber. For those of you that don't know, I review the preliminary applications. I keep in touch with the applicant up to the conclusion of the project when you submit the final application. Bankaj did mention a little bit about, on her last slide, the scoring criteria. I'm going to go into that a little more in depth. It's going to obviously be a change for all of us. It's new to myself and new to you guys. I believe that Bankaj did mention that on our website, there is a scoring guide. It will walk you through the process. It provides more elaborate information about the entire scoring process. So that is out there. Definitely want to review that and get to know it a little bit. Okay, so we can get started here. The preliminary application, evaluation, and scoring. Mark did mention earlier there are 4 scoring criteria worth a total of 100 points. Those 4 are overall size and quality of the project, level of economic distress, net fiscal benefit, and the input from local elected officials. The first criterion is the overall size and quality of the project. This is worth a total of 35 points. The first is leveraged investment. That has a value of 5 points. Leveraged investment is simply the total project cost divided by the tax credit request. Secondly, the number of new jobs to the state to be created by the project, worth 5 points. Third, the average wage for new jobs to be created by the project is worth 5 points. They need to be equal to or greater than the county average wage. Fourth, potential multiplier effect of the project based on the project's industry. This is worth 5 points as well. It will also be based on the M-plan model provided and based on the majority of activity in the building. The multiplier uses the first 2 numbers of the NAICS code for the project's industry. So we've required NAICS in the past. That is just going to be the first 2 numbers is really all we're going to use, as opposed to, I believe it's 5 typically is what some submit. All right, the last item on this, number 5, is the financing committed, and that has a value of 15 points. It's a weighted preference for applicants who have financing and/or equity already in place and are ready to begin development. There's 3 financing types. That's private, public, and other. Criterion B is the level of economic distress. There's 30 points available for this category. The first is the project in a federal opportunity zone? That's worth 10 points, and this is based on the project's census tract if it's designated as a federal opportunity zone. Again, this is new. The scoring guide will, walk you through the process of determining this. The second item is a qualified census tract worth 3 points. The project census tract is designated as a qualified census tract. It's a census tract with a poverty rate of 20% or higher. Third, the project county's level of unemployment, 4 points. This is a weighted preference for projects that will create economic growth in distressed areas. This measure uses the unemployment rate of the county during the month currently available preceding the start of the application period. Fourth, the project's census tract's overall poverty rate is worth 3 points. Again, it's a weighted preference for projects that will create economic growth in distressed areas. This measure uses the poverty rate of the property's census tract. And lastly, number 5, vacant property 10 points available. A weighted preference for buildings that are underutilized or not occupied and will generate a greater catalytic impact upon completion of the rehabilitation. Vacancy is measured over a 1-year period, ending on the date on which the application must be submitted. Criterion C is the net fiscal benefit. It has a total of 25 points available, and this is a weighted preference for projects with the greatest return on investment. DED, Business and Community Solutions, will conduct a cost-benefit analysis based on the data provided in this section and award up to 25 points based on the ROI, the return on investment, from the project to state and local governments. The first is the state cost-benefit analysis. That will be 15 points available. I would like to add that the state portion will utilize the REMI model, which is largely dependent on the investments that will be made as well as the new jobs that will be created. Secondly is the local cost-benefit analysis. This is 10 points available, and for the local portion, the area which has the most local impact is determined by the increase in property taxes as a result of the increase in value of the property after the rehabilitation is completed. Also to note, these will not be self-scored. You will not need to complete this section of the application. We will do that on our end. And lastly, is criterion D, is the input from local elected officials. 10 total points available. Local participation and support. It's a weighted preference for applicants who have received an indication of support from their local jurisdiction, town, or county. If the applicant is documenting an indication of local support, you need to include a letter supporting a Missouri Historic Tax Credit project. The letter should be signed by the mayor, local jurisdiction, or the county executive of the county where the project is located. This must be dated within 6 months of the date of the application submittal. Or you can include a resolution of support passed by the legislative body of the municipality, the county commissioners of the county where the project is located, supporting the project's application for the Missouri Historic Preservation Tax Credit Program. The resolution must be dated within 1 year of the date the application was submitted. Additional points will not be awarded for submitting multiple letters of support. This concludes the scoring portion. Again, we will answer questions at the end. For now, I'm going to pass this on to Jennifer Kingsbury, who is one of the accountants for the Historic Tax Credit Program, and she's going to discuss the cost certification process.
Thank you, Landon. Good morning, everyone. My name is Jennifer Kingsbury, and I'm the cost reviewer for the Historic Tax Credit Program. I review the cost portion of the Historic Tax Credit projects that come in for tax credits after the work is done and after we receive final approval from SHPO. I'm here to discuss with you all some of the changes to our cost certification guidelines for the new rules. Okay, let's talk about some of the new cost certification, or excuse me, the new soft cost thresholds that are into effect. The first thing I'd like to discuss with you is the new developer fee threshold. In our old rules, the developer fee was capped at 20% of total project costs less non-QREs, IOI fees, profit overhead, and the developer fee itself. Now it is 12% of total project costs less non-QREs, IOI fees, profit overhead, and the developer fee itself. Another thing
Brianna, press 5. If you'd like to speak to our receptionist, please press 0. Say.
The overhead and general requirements categories in our old rules were in their own separate categories and thresholds. Overhead was 2% of total contract costs less overhead, profit, and general requirements. And general requirements was 6% of total contract costs less overhead, profit, and general requirements. Now they are combined into one category to make things more efficient through the review process. The threshold for overhead, including general requirements, is 4% of total eligible project costs less IOI fees, profit, and overhead. We will also include the general requirements cost as part of the calculation of the 4% threshold. The profit threshold in our old rules was capped at 10% of total contract costs, including change orders before. The profit threshold in our old rules was capped at 10% of total contract costs, including change orders before contractor profit, overhead, and general requirements. Now it is 6% of total eligible costs less IOI fees, profit, and overhead. For the other fees in our previous guidelines, there was no threshold indicated and it was not addressed. Now for the new rules, if there are any fees that were originally part of another category, for example, if supervision was originally in the general requirements and it was backed out and put into its own category on the cost certification, we will be looking closer at the supervision, regardless of whether or not it's an IOI fee. Also, any other fees in general that could be part of another fee will be reviewed more closely by DED as well. Just as a reminder, the items of the general requirements costs include building permits, temporary sheds, construction trailers, toilets, tool storage, shops, walkways, fences, guardrails, and medical or first aid facilities. Temporary heat, water, communications, light, and power to job site for construction. Cleanup and rubbish disposal, watchman's wages, alarm or police monitoring, or other security costs to prevent theft and/or vandalism at the job site. Medical, first aid, and related costs at the job site, including ice and equipment rental. Okay, let's talk about the smaller projects. These are the project costs that are less than $250,000 in total project cost, excluding acquisition. We need invoices and proofs of payment compiled by the CPA that is licensed in the state of Missouri, and it needs to be in order of the EXP form. The EXP form may list expenses in either date paid order or by category of expenditure. Please submit the original EXP form and the original CPA's compilation letter in hard copy. We will need invoices, executed construction contracts, change orders, architectural contract if applicable, timesheets, or other contemporaneous documentation showing expenses were incurred. We will need proof of payment to include copies of canceled checks, bank statements, and credit card statements. The bank and credit card statements must include the name of the payee on them. We will also need all sources of funds, including but not limited to loan documents, promissory notes, and deeds of trust if applicable. Now let's discuss for the bigger projects in which total project costs are greater than or equal to $250,000, excluding acquisition. Some of these requirements are different from the requirements of the smaller projects that we just talked about. We need the EXP form and original CPA opinion letter in hard copy. We may ask for an Excel version of the EXP form via email upon request during cost review so that we may search through the proofs of payment more efficiently and we do not delay the review process. Another thing, please keep in mind that the DED reserves the right to request additional documentation during the review process. Another thing I would like to point out is please do not send all the invoices because it's cumbersome for us. You can find the QREs and non-QREs at the following website on this slide. They are there in great detail. And we are now opening up for questions.
We did have one question earlier asking how the IOI fees are defined. And then please.
Okay, so it basically would be anything if for example, the applicant has several entities and they have another entity that's being used for the general contractor, that is an IOI fee. It is also a related party as well.
Okay, and we have a question from Michael. We're going to unmute him so he can ask his question.
What about applications that were submitted, for instance, like in November or December of 2018? How do those get addressed with regards to these new processes and rules?
Michael, we will follow up very shortly with written guidance on our website for existing applications, and we'll send letters to each applicant based on when their application was received and the status of it.
Another question from Fred. Has the standard changed from tracing every payment to an invoice, agreed upon procedure, or a compilation report?
No.
With regards to payments by credit card, the credit card, does that need to be the applicant name, or can that be in an individual's name who is then reimbursed by the applicant?
It needs to be in the applicant's name. We cannot accept we cannot allow any third-party payments on any future projects.
So a credit card needs to be opened in the applicant's name?
Right.
And what about credit card payments by the general contractor who's hired by the architect, or by the applicant?
If the general contractor is a related party, it needs to be in the general contractor's name, and then we would also need to see proof that the applicant paid the general contractor.
Sure, okay, thank you.
We have another question. This seems weighed to commercial projects for job creation. How would an apartment project fare in the scoring?
In regards to the scoring for an apartment project, we would need to take into consideration the actual number of jobs created, which for this type of project may not be significantly large. Additionally, the local benefit as well as the state benefit would be other items that would be taken into consideration. What we're really looking for on, these types of projects is something that's going to generate more economic activity and bring jobs to Missouri, as well as local municipalities. That's really what is going to have the biggest impact are those types of projects.
One other area that an application for an apartment project could really emphasize on is the distressed area, whether that's a qualified census tract or opportunity zone. There are many points available for that.
And again, this is, the scoring criteria is just for projects over, 1.1 million or 275 in QRE. So if your housing project is, under the 1.1 million, then obviously, it doesn't go through the scoring process.
Another question, if cost is paid by a third party or related party initially, can we submit proof that the costs were reimbursed to that party by the project for inclusion in the QRE?
No.
This also seems to be weighted to large projects. Is A2 on job creation measured per dollar of tax credits or just over number of jobs?
Yeah, it's just simply the number of new jobs that, to the state that are going to be created by that project. In the scoring guide the scoring guide, it basically says there's a total of 5 points available for the new jobs, and greater than 100, for instance, would be 5 points, and then 81 to 100, or 81 to 99 is, 81 to 100 would be 4, 61 to 80 is 3, and so on. But yeah, that's just strictly new jobs created.
Will there be any preference for nonprofit organizations?
No, the scoring guide does not contemplate any additional points for not-for-profit organizations.
Will location of site be a factor?
Yeah, it depends on where the project is located. If it is located within a federal opportunity zone or qualified census tract, then they will get more points.
Is there a per project cap on credits allocated?
No. The statute does not contemplate a per project cap.
Do I understand correctly that a building permit is required as part of the initial application? This seems out of sequence.
Yes, this was recently one of the changes as a result of Senate Bill 590. So yes, going forward, building permits as well as land approvals will be required as part of the application submission for all projects. That includes projects over $275,000 in tax credits and those under $275,000 requesting tax credits.
And one thing to point out from the statute, it mentioned that it's a copy of all land use and building approvals reasonably necessary for the commencement of the project.
The location question from earlier was related to rural versus urban project locations. Is there an incentive for out-of-metro projects?
There's the distressed area as well as the qualified census tract, but that would be the two items that I would say would relate to that.
Does DED wait until SHPO approval before reviewing these criteria, or is it dual tracked?
No.
We review the applications, the scoring criteria first, and then we score them, and applications will be prioritized in the order of the scores they received, and top scores applications will be forwarded to SHPO review.
Will proof of a building permit approval be sufficient, or does the application have to actually pay for or pick up the permit?
Typically, we would prefer to see the actual application or the actual approved permit itself, but we realize that at the time of application submission, that may not be available. So we can certainly work with you on that, and we can look at accepting the application for the permit.
And from my understanding, some of the counties may not require permits for certain type of work, such as if you are, fixing the roof, installing windows, or redo the kitchen floors, painting. That type of work do not require permits. So we will review the type of works that you propose as well in, comparison to if the permits are required or not.
If the application doesn't get selected for the lottery, will it be required to be resubmitted or stay in the pool?
It depends on the scores that you receive, which tier your application is. If it is tier 1, we will keep your application until we have the funds available for the next fiscal year.
Tier 2 and 3?
We will not keep that.
We will not keep them. You would need to reapply for the next application cycle or one of the cycles down the road if your application's in the tier 2 and 3.
The cost of an architect for preparing plans or for historic consultants preparing National Register of Historic Places nominations often are incurred more than 1 year prior to submittal of an application. So now these soft costs will be disqualified as QRE?
That is correct.
Yeah.
Will we receive notification as to whether the project is selected as tier 1, 2, or 3?
Yes.
Yes.
What about projects requesting more than their allocated amount?
As an additional credit?
They have to wait until we complete the cost review just to determine what is the actual amount of the tax credits that they are eligible for. If it is more than the original approved by DED, then the excess of that will be considered request for additional tax credits as part of the new application for review purpose, according to the statute.
Will we receive notification if an application is incomplete and not being further considered?
Yes.
The chances of getting a building permit before getting historic approval is slim to none. Drawings need to be finalized and cannot be finalized without approval.
Right, we kind of touched on that earlier. We'll certainly work with you on that new statute requirement, and you can submit your application that you submitted for the permit, and we'll review that on a project-by-project basis.
Yeah, we understand this is that part is a challenge, the permit part, but I mean, that was statute, so we're going to do what we can to, to lighten that burden for you guys, but at the same time, we need you to try to come up with what you can.
Contact information for the team is up here. There are a couple questions that are a little longer, more substantive, and thus just require a more tailored explanation than we have time for on this call. So we'd ask that you reach out via email to our team here, and we'll get those answered for you. And again, we just want to thank you for the work you guys are doing in our communities to revitalize them and use this tool to really bring new life to buildings that haven't had them. The new statutes put in place these evaluation criteria, which make sure that we try to get the absolute best projects out there that are going to make the biggest impact in our communities. And it does change the cap, which means we have scarcer resources that we have to figure out how to use well. These regulations, guidelines, and applications are designed to do just that and also to streamline our processes here at DED. We're excited to work with you guys to continue bringing new life to our communities across the state, and don't hesitate to reach out with any questions. Thank you guys for your time, and have a great day.